So I guess the best way, I know we've sort of talked about a couple of these issues in the past with, a lot of the people here. So I guess, hold on, let me just share my screen and then I'll talk to it. So what I would say is that I was last week, I was in Denver, meeting with the management teams at Liberty. So, that's John Malone, Greg Maffei, Mike Freeze, who runs Liberty Global, and Bolin Nair, who runs Liberty Latin America. And so I think a lot of the discussion was around, especially with Dr. Malone on the economic side, was really around just sort of how the market's changing, the public markets especially. Inflation is here to stay. It might not be 6%. Stephen can tell you much more about this than I can, but it might not be 6%, but maybe it's 3 to 4%. And we've sort of seen a move in, the 10-year treasury up because of that. So the question is, how do you invest in the public markets accordingly? And, I think what we've sort of realized is it's sort of a twofold barbell approach, right? We have a positive view on the cloud through a couple of our ARS strategies. We're invested in, Google, Microsoft, Amazon. And so we think that those are obviously the businesses that are quality, they have real barriers to entry, and the number of workloads going into the cloud is still sort of increasing or accelerating. And so we think the free cash flows of those businesses and the growth that you're getting through them is sort of here to stay. They all put up somewhere between 37 and 45%, or 53%, I think, for Google Cloud revenue growth. And so we think, paying 12, 15 times EBITDA for these sort of stable quality revenue streams still makes sense even here. And then on the other side, sort of the other end of the barbell, what we're trying to do is we're really trying to find the businesses, like Mark said, that have real free cash flow. One of the things that Greg Maffei said was, you're basically trying to pull the hype out. And so there are so many businesses in the last, couple of years that have really, SPACs especially, right, and some of the businesses they've acquired have just been, businesses that haven't generated real ROIs. And I think our goal is really finding the businesses that we think are kind of off the beaten path and have, kind of great ROI characteristics because they have real technology, they have real management teams, and when we sort of underwrite where we're buying the stock today, we think we can make multiples of returns into the future because these aren't well-known businesses. So again, back to the Liberty meetings, when we were talking about, broadband growth, clearly with 4K, 8K video, the numbers you're seeing out of the cable companies of what consumers are consuming in the home is pretty astounding, right? And I think we all know COVID accelerated that. And so the thing that Dr. Malone was saying was that, you still have to think about technology obsolescence. And he mentioned LEO satellites by name, and I know it's a discussion we've had in one of Mark's Tuesday meetings, but we're invested in a company that they have sort of a legacy satellite fleet that's declining about 5% a year, but we're buying the business at $24, and that legacy satellite fleet is generating something like $5 in free cash flow per share, right? So we're buying this legacy asset at 5 times earnings, 5 times free cash flow, and then they're building this LEO business, and that LEO business is now fully funded. We've looked at the architectures of all of the LEO constellations. We think this is sort of the most interesting one with the best architecture and will generate the highest returns on invested capital. Again, they fully funded it. It's not going to fully launch because they're building it right now. It's not going to fully launch until 2024. So you don't start to see the benefits of the cash flows in that business till then. But I'll give you a little bit more detail. Hopefully I'm not overcomplicating the situation. But basically, this was a private company, and it was 2/3 owned by a public company. And then what happened was the other shareholder of the private satellite company, they owned 1/3 of it, and they wanted liquidity. So what they did was they merged the public entity with the private entity. And so this has it didn't go through the straight IPO path. It has no research coverage right now. I know Goldman and JP Morgan are sort of kicking the tires on it. So we think that's one catalyst to it. But the point is, it's so undervalued because people just don't know it exists. And there was some weird index selling that happened in this name because of the way the merger happened, and they dual listed in the US and Canada. So anyway, long story short, cheap, really good technology, very good management team, totally underfollowed, and fit sort of some of the secular themes that we believe in, at ARS, and, kind of validated by John Malone, who I would argue is probably one of the smarter, capital allocators in this industry. So, that's kind of just a flavor for the types of stuff we look at and how we're essentially trying to do things a little differently than buying, except for the, 3 companies I mentioned with the cloud exposure. We're trying to do things very differently than other people. A couple of people on the call mentioned Fintech. So again, baby thrown out with the bathwater. We are invested in a public company. Stock's down 70%. With sort of the drop in crypto and where interest rates have gone. And this is a Canadian fintech company. We've gotten to know the CFO and president, really well, to the extent that we're emailing a couple of times a week now, and talking to him every month or so. And so this business, they bought 40% of the basically the Coinbase of Canada. And then they bought a piece of a crypto exchange in Canada. And then they also bought a broker-dealer, and they did all of this in 2020. And so what they did was they used that broker-dealer to create a free stock trading app. So if you look at it, it looks exactly like Robinhood, but the difference is they're not selling, the volumes. They're basically making money on the app based on FX. So when people in Canada, trade U.S. stocks, they make a little bit of a vig on the FX. So that's how they're making money off this. What we like about it is, one, it's down a lot. It's a $250 million market cap. They have $100 million in cash. So we're paying $150 million for an enterprise value for this business. And they just launched the stock trading app. They're still in the process of back-ending the crypto and the NFT into the app, so all of their customers can kind of trade all 3 on the app. And so we like the dynamic in Canada because they effectively have to regulate or get regulated in every province, especially. And so that's why you've seen a lot of U.S. foreign companies not move into Canada with fintech. So we think the barriers are high. And the other thing we like is that, as everybody knows, Canada is sort of a little bit different of an animal in terms of the banks being a little stodgier. And so they're not doing what the U.S. Retail brokers have done with free stock trading. They're still keeping the, $8, $10, $12 a trade. So the interesting thing here is that, again, we use a lot of data science in what we're doing. And so, we're looking at the App Annie data in Canada, and we're seeing that this is, despite the fact that it's, again, a couple $100 million company, they have the second highest app downloads of finance apps in Canada on App Annie after PayPal. So, they're really growing. And so, when you look at that data and you kind of back into numbers, the market has them growing their subscriber base by 75,000 a quarter. They've already done 100,000 downloads in January on, the app. And so the point being, this is the kind of business that we want to own. I was on a call that one of our sell-side brokers put on with Gemini, with the president at Gemini yesterday, and he was saying they raised money at $7 billion. Canada's not the size of the U.S., but if these guys are doing the exact same thing, they have the credit card or the debit card that pays cash back in crypto. So they're sort of doing the same thing. Yes, the market might be 1/10 of the size, but Gemini's raising money at $7 billion. I don't know why this company isn't worth $1 billion plus when it's trading at a couple $100 billion. So, these are the kinds of opportunities we're looking for in the public markets. In terms of my background, if that's helpful, as we were talking about earlier, I got into the investment business in 2006. I was at Tiger Europe, 2009 through 2012, and then I was at Cobalt and ran the TMT consumer sector. Is about $500-600 million in exposure for Wayne Cooperman there. Launched Papyrus in 2016, folded it into ARS to work with smart people like Steven every day, which is nice. So that's kind of a nutshell of what we do, where we're seeing the value in the public markets. Again, back to Liberty, Greg Maffei was saying, there's a lot of hype, right, in these markets, like I was talking about earlier, but if we can find those babies thrown out with the bathwater, like I think we have, where the satellite company's down 50%, the fintech company is down 70% from the highs. So, a whole portfolio of those we think will outperform. And, we have an investor who came in late last year, and this is somebody, I've grown up in the same town as me. He owns kind of a copper smelting, steel fabrication business, and he had told me that he was putting money in just because he doesn't want sort of exposure to the high growth stocks at ridiculous valuations and the FANG stocks. And so that's kind of the type of investor, and old boss put in money a few months ago on the same thesis. So that's sort of the types of investors I think that this strategy appeals to, where we can hopefully get the upside of, the last few years of technology and kind of get that technology exposure, but, do it in a way where we think the risk reward is better. And obviously we're doing it with a lot more diligence into the businesses we're buying than sort of, buying the names that move the index, if that makes sense. But that's, yeah.
I know that ARS does these 6 transformations and which play into what you do, but if you were just to get some themes that you see, so sub-themes of that you think we will see playing out across all asset classes in tech.
Yeah, I mean, it's funny, I'm writing our quarterly letter on that exactly right now and kind of listing them all out, but I think one is obviously digital acceleration, right? You've seen that you've seen that in the cloud, right? You've seen that, like, Satya Nadella is talking about in factories. You're seeing more automation, one, because it was accelerated in COVID, just because, they wanted to keep people out of factories. You're obviously seeing that with business processes. You're seeing that with the consumer, right? Even with streaming, the average consumer uses so much more data streaming than with linear television. So cord cutting really boosts the value the cable companies get from a broadband perspective. And so we own Charter, for example, at 12 times free cash flow, buying back all their stock with free cash flow. $650 stock, we think they do $150 in free cash flow per share in 4 years. So, you're trading your big business, very stable, very predictable, secular themes that we like, trading at 4 times free cash flow a few years out. On top of that, we think that, Fintech is here to stay to some extent. We're still getting our arms around to the extent to which crypto and NFT and sort of that trading is, stimulus money versus what's long-term and what's sustainable. Obviously, we think, the blockchain side is more sustainable. And so, that's another area, again, by this Canadian fintech I was mentioning. Another area where we see value, same thing in overall data in terms of DRAM and memory. We think that, businesses that are oligopolies like memory are, somewhere where we think companies are trading at 12, 14 times earnings and growing with real price rationality. So those are kind of a few of the themes that I think we're playing, if that answers the question.
Yeah. Any other questions?
Nitin, can you just touch on, there was some interesting comments out of the meeting about inflation and deflation pressures on pricing, and I think that's a fascinating area to just lay out since inflation is such a big topic.
Yeah, so I think our view on some of that is, supply chains are out of whack right now. We think that abates in the next 9 months to a year and a half. We think the chip shortage abates in the next 6 to 8 months. And so, our view is kind of similar to exactly what John Malone said. We're at the 6% plus inflation level right now. If that drops to 3 to 4%, we think that's a little bit more sustainable. That probably means 2.25% 10-year. The issue, I think, that we're looking at, though, is that we see energy inflation as a little bit more persistent. But aside from all of that, we think things are going to come back to normal to some extent. And we think multiples, again, probably of the high growth businesses, some of that gets sucked out into the market, especially as the Fed tapers. But we think that, again, these businesses, like some of the FANG businesses, some of these other businesses I told you about that have lower multiples, we think there's real value in them. So that's kind of our view on all of that.
So before we move from big picture, any questions on themes? Was that a little bit of a knock? You don't know if NFTs are going to...
We don't know. I mean, we think it's going to be real, but the question is it going to be real at 30% of today's volumes or, 150%? We just don't know, right? I mean, I think it's pretty amazing. It's sort of a provenance for, kind of what's real, but the question is, pay-to-play games, I think, is one area that I question whether or not there's excessive sort of inflation in some of these games. But, I'm certainly not the expert in that. We just try to go where the cash flows are, I think, because that's what we can justify.
But do you think from the NFT space, look, art is obviously, it's hot right now, it's gonna dry down. I don't see that continue. But in terms of everything and anything in the world is experienced, right? So if you look at anything that you can sell and create an experience around it, doesn't matter, it's an event, to meet with Mark Sainer, pay $50, he can give you access to X. Or you go to a fitness contest, you get to meet with Arn, are you willing to pay extra $500,000? Warren Buffett, if he's speaking, look, if you're able to pay $100,000 more, and Disney the same thing, right? So if you look at how these channels work, the experience-led economy will sustain. Is that your point of view, or you think that's?
I mean, yeah, I just don't know how that kind of general ledger system, how is that different than what you can do today? I just don't know how that's monetizable and how you sort of invest in it, how you make money off of it, I think, is really.
That's why we have venture.
That's another thing, like if you have companies like Live Nation, you have companies like Ticketmaster and StubHub. So these tickets are getting sold over and over, but the originator who's actually putting that experience, who's the co-owner, all of these resales are making money, 20, 30, 40, 50% margin, right? But the person who's actually creating that experience, he doesn't, but through the general ledger, that money is passed on to the originator. If you're able to make, after, let's say, a Rangers game, ticket is $100, sold at 150. Who's making that endpoint? StubHub, Ticketmaster, or somebody